In this lesson, we are going to slow group consolidation down. Not because it is easy, but because most mistakes happen when students rush. In SBR, a group question is not one giant calculation. It is a control panel. Before you calculate, you need to switch on the right checks. Time, control, investment carrying amount, goodwill, impairment, NCI dividends, ownership changes. If one switch is wrong, the numbers can look busy but still be wrong. So let us build the control panel properly. First, the time gate. If the subsidiary is acquired halfway through the year, the parent does not control it for the full year. So in the consolidated statement of profit or loss, you only include the subsidiary from the acquisition date. Revenue, expenses, finance costs, tax, everything from the subsidiary is time apportioned from that date. Example, the parent acquires the subsidiary on 1st July. The year end is 31 December. That is 6 months of control, not 12. If the subsidiary made profit after tax of 120 for the full year, the group starts with 60 before any extra adjustments. The same logic applies when control is lost during the year. Consolidate up to the disposal date only. The exam habit is simple. Draw the year first, put the transaction date on the line, then calculate. Second step, acquisition. This is where the parent already had an investment before it gained control. The mistake is to use the old carrying amount without updating it. If the previous investment was an associate, bring it to the date control is obtained. Opening carrying amount plus share of associate profit to the step date, less dividends if relevant. Then, when control is obtained, remeasure the previous holding to fair value. So the bridge is opening investment plus movement to the date equals carrying amount at the step date, then fair value remeasurement. Students often remember fair value but forget the profit movement before fair value. Third, goodwill impairment when the impairment amount is not given. Sometimes the question says goodwill is impaired, but instead of giving the impairment, it gives a recoverable amount. That is not missing information. It is a signal. You must calculate the carrying amount of the cash generating unit at that date. That means goodwill plus the carrying amount of the subsidiary net assets updated for post-acquisition movements, fair value depreciation, and any relevant adjustments. Then compare that carrying amount with recoverable amount. If carrying amount is higher, the excess is impairment. And then remember the method. Under full goodwill, goodwill impairment is shared between parent and NCI. Under proportionate goodwill, only the group share of goodwill is recognized. Fourth, present value balances. If a liability is measured at present value, the discount unwinds over time. At the year end, the liability increases and a finance cost is recognized. This appears in deferred consideration, provisions, and similar discounted liabilities. The exam question may not shout about it. It may simply give a present value and a discount rate. That is enough. Ask, have I unwound the discount? Fifth, NCI in profit or loss. NCI does not receive a percentage of consolidated profit. NCI receives its share of the subsidiary's adjusted post-acquisition profit. That means you start with the subsidiary, not the whole group. Then adjust that subsidiary profit for fair value depreciation, goodwill impairment allocation where relevant, and unrealized profit where the subsidiary is the seller. Only after that do you apply the NCI percentage. This is a very common mistake because consolidated profit is already sitting there, looking tempting. Ignore it for NCI. Use the subsidiary. Sixth, goodwill and retained earnings. Goodwill is calculated at the acquisition date. After that, goodwill is carried forward, reduced by impairment. And if the subsidiary is a foreign operation, affected by exchange movements, but post-acquisition profit, additional depreciation and unrealized profit do not normally belong inside the original goodwill calculation. They usually affect group retained earnings and NCI. So ask this question every time. Is this an acquisition date measurement or is it a post-acquisition movement? Seventh, dividends from subsidiary to parent. If the parent recognizes dividend income from the subsidiary, that income must be eliminated in the consolidated statement of profit or loss. A group cannot earn income from itself. So deduct the parent's share of the subsidiary dividend from investment income. This does not mean NCI profit is calculated after dividend. NCI share of profit is based on profit, not distribution. 8th, parent sells shares but keeps control. If control is retained, this is not a disposal in consolidated profit or loss. It is an equity transaction with owners. Increase NCI for the share effectively sold to NCI. The difference between the consideration received and the increase in NCI goes to equity. No gain or loss. No goodwill remeasurement. If full goodwill is used, NCI carrying amount includes NCI's share of goodwill. If proportionate goodwill is used, it does not. 9th, parent buys more shares from NCI while control is already held. Again, control has not changed. So do not recalculate goodwill. Reduce NCI by the proportionate reduction in its carrying amount. If NCI falls from 30% to 20%, the parent has bought 1/3 of the NCI balance. The difference between price paid and the decrease in NCI goes to equity. No gain or loss. No goodwill remeasurement. 10th, bargain purchase. If the acquisition calculation gives a bargain purchase, reassess the numbers first. If it is still valid, the gain is recognized by the acquirer. That means it belongs to the parent, not NCI. Do not share negative goodwill with NCI. Now let us finish with the checklist. Before you start a group question, ask these 10 questions. When did control start or end? Does any investment need updating to the transaction date? Was recoverable amount given, meaning impairment must be calculated? Is there a present value liability that needs unwinding? Is NCI being calculated from the subsidiary's adjusted profit? Have I separated goodwill from post-acquisition movements? Have I eliminated dividends inside the group? If shares were sold, was control retained? If shares were bought, was control already held? Does any bargain purchase gain belong only to the parent? That is the discipline. Group consolidation becomes calmer when every number has an address. Parent, subsidiary, NCI, goodwill, equity, profit or loss. Put the number in the right place and the marks become much easier to protect.